to our Buy-to-Let weekly update. Your eyes don't deceive you, I am back in the office. For my first time for filming, the office has actually been open for many weeks now, but we're working on a kind of bubble rota. And it just so happens that the days where I've been doing the filming, I haven't been in the office. Or I've been in Greece on holiday, which I'm obviously back from now. And thank you, by the way, to everyone who sent me messages wishing me a great holiday. I really appreciated it. So yeah, I'm back into the office today, no longer on holiday, and today is a fantastic day because I, like many other happy parents, have sent my child back to school. What a long 6 months it's been. I don't know about you. I think judging by the conversations I've had with with clients who are also parents, I think many of us have learned that our natural vocation is not teaching, and we've got a newfound respect for those people that do it as their profession. And yeah, as my son pointed out to me, I am the worst teacher he has ever had. And as I duly pointed out to him, he is the worst pupil that I've ever had. But great to see the kids back at school, and really hoping that now we really start to see things start to evolve and improve as people can get back to work. Now, in terms of what's been happening in the buy-to-let lender world over the last week, it's quite quiet. Back end of August, bank holiday week, I don't think we were ever expecting to see a huge amount of movement. A bit of jostling on pricing. Virgin have increased their buy-to-let rates by 0.2%. Skipton have increased some pricing on selected products. We have seen platform home loans come back into the buy-to-let mortgage market. They remained in the residential lending space the whole way through, but back into buy-to-let. And they've actually come out with some fairly keen rates, with 2-year pricing starting, or 2-year fixed rate pricing starting at 1.44%. In terms of platform as a lender, they're perfectly good. Their offering is fairly straightforward and vanilla. They're not looking for landlords with large portfolios. They're not lending on, multi-units, HMOs. They're not lending to people at limited companies. But if you sit in that more vanilla end of the market, their pricing is very good. The only other change we've seen in the last week is that Vida Home Loans, having come back to the market only just over a week ago, have already increased their rates. Probably they got really snowed with applications straight away. They came in, as I mentioned last time, with a bit of a bang at 85% loan to value, the only lender to be in that space at the moment. And I guess they've had a rush of business and have taken a decision to increase their pricing to just kind of dumb things down slightly so their service doesn't fall over within their first couple of weeks of being back in the market. We are expecting to see more changes from lenders over the coming weeks as people really get back after the summer break as far as it was one. So expect more news on lender activity over the coming weeks. Bit of property market data for you now. So the average number of sales agreed per estate agent branch stood at 13 in July, the highest figure recorded since June 2007, according to the latest data from NAEA Property Mark. What they're saying is that year on year, the number of sales per branch has increased by 44%, rising from 9 recorded in July 2019. Indeed, the number of house hunters registered per estate agent branch rose by 13%, increasing from 379 in June to 428. Year-on-year housing demand is up by a third, rising from 316 in July 2019. They also go on to say that supply also rose in July, with the number of properties available per member branch totalling 43, increasing from 37 in June. Year on year, the supply of housing increased marginally from 41 properties per member branch in July 2019. The number of sales made to first-time buyers stood at 25% in July, a fall from 29% in June. Now, looking at this data, I think really what we can take away from here is that the boom, as it were, the interest, the people looking to move house, acquire properties at the moment continues. It's interesting to see the slight downward movement on first-time buyers, but I mean, it could just be that's just a 1 month figure and an anomaly rather than a continued theme. So we'll continue to monitor that. But really just to reiterate the fact that the housing market continues to be performing well, largely we suspect supported by the stamp duty holiday. Now, the other bit of housing market data that I wanted to just share with you this week is based on some data released from the Mortgage Works. And I did some information from them last week as well, but they released some really good reports, which I really enjoy reading, because they're produced from data they've collated from landlords. And what they've just released is their regional snapshot for Q2. So bearing in mind this information is slightly old, but it's still very interesting nonetheless. So what they have reported is that profitability remains strong, with 87% of respondents making a profit in Q2, and the average yield increasing to 5.8%. Now, interestingly, landlords in Yorkshire and the Humber were the most positive respondents, with 55% feeling good or very good about rental yields over the following 3 months. Possibly because these landlords also reported the highest level of increasing tenant demand. Now, the lowest reported increase in tenant demand, I guess somewhat unsurprisingly, was in London. And the reason I say unsurprisingly here is that the London market is always the one which seems to have the strongest reaction in times of difficult time frames or periods of economy. So I don't think the London market is doomed by any stretch of the imagination, but it's not unsurprising that at the moment they have felt the highest level or the strongest level of reduction in rental demand. Having said that, having spoken to my clients who have investments in London, that does certainly seem to be picking up. And as I've just mentioned, this report is from Q2, and obviously we're at the back end of Q3 now, and the world has moved on a lot since then. So I think when we come back to revisit this data in 3 months' time, I suspect the sense from landlords will have moved on somewhat. Some information has come out from the Bank of England, which is stating that the mortgage market has shown more signs of recovery in July, albeit remaining weak in comparison to pre-COVID levels. Now, what they've said is that mortgage approvals increased to 66,300 in July, up from 39,900 in June, which is obviously an incredibly large uptick. So approvals are now 10% below the February level of 73,700, but 7 times higher than the trough of 9,300 in May. Net mortgage borrowing was 2.7 billion in July, which is higher than the 2.4 billion in June, but below the average of 4.2 billion in the 6 months to February 2020. So what this really shows is that things are moving apace with the mortgage market. More mortgages are being approved. I guess the question is how come? And I think there's partly down to more lenders being back in the market, but also actually it's really been driven by purchase activity. With more people looking to buy property, which again, as we know, is largely underpinned by the stamp duty holiday, but also just the pent-up demand, which was building up in the run-up to Brexit, and then obviously further delayed with regards to COVID. So, with this in mind, I thought actually it would be a really good time just to do a quick refresher for you on where we are with the buy-to-let mortgage market. Things are changing still all the time. And I know that I still get clients emailing me saying things like, I want to buy an HMO, can I even get an HMO mortgage at the moment? So there is some real confusion, understandably so, with regards to where lenders are. So here's a quick recap for you, which I hope you find helpful. So first of all, the maximum loan to value you can get on a buy-to-let mortgage is now 85%. This is available for individuals and limited companies, and it's available on standard properties, HMOs and multi-units. Is the pricing good at 85%? It's toppy. There is more choice at 80%, and 75% is really where the market starts to open up. But for those people who are looking for an 85% mortgage, there is now an option for you, which there was not 2 weeks ago. We now have 36 lenders lending at 75% loan to value and above, and 7 lenders lending at 80% loan to value. So again, a shift upwards in terms of the number of lenders playing in this space, which invariably tends to have an impact positively from a borrower's perspective on pricing. We've also got lenders who have come back to market on student lets, with just one lender that I can think of who is still not accepting student lets, but stating they're very much keeping their doors open to this once they have a full kind of understanding and can get comfortable with the student letting proposition. So in my experience, most of my clients that I speak to who have student properties have reported that these are all now fully let and the tenants have all moved in. So actually, I think there's been a really great return on the student market, and the lenders are now very happily accepting student-let applications or on HMOs. So also we've seen lenders come back to lending on holiday lets and short-term letting or Airbnb. Again, during lockdown, when people weren't able to stay away from home, and thus properties which are holiday lets and Airbnb stood vacant, naturally lenders were very cautious about lending on these properties and scaled back, but the doors have reopened again on this side of things. We've also seen an increase in lenders who will accept expats, and indeed we have seen essentially lenders come back to market or revisit the market, those lenders who stopped lending on limited companies as well. So I think it's fair to say that we are largely back to pre-COVID conditions in terms of choice of lenders and lenders' desire to lend on the more kind of complex end of the market. Indeed, it's very rare that we find a scenario now where we have to say no to a client in terms of their requirements. I think, as always, we come back to this thing that clients' expectations on pricing is the thing that's harder to overcome. But once they get their heads around that, it's very rare that we can't help people. So yeah, really positive news in terms of where the mortgage market is now. The other thing I just wanted to touch on, which I know there's some speculation about, and we get asked quite a lot, is about interest rates and what our thoughts are on these over the coming months. Particularly speculation that interest rates may indeed turn negative. Now, for what it's worth, my opinion on this is that I can't see that happening. I think that the economy is doing better than some predicted. Inflation is now at 1%. So I think as it stands at the moment, I don't think that's going to happen. Interest rates going negative is going to happen. Now, this could all change if suddenly we go into a second wave of lockdown and things take a turn for the worse. But where we are at the moment and looking forward, I think it's unlikely. But I think really the question we need to ask ourselves is, if interest rates do turn negative, actually what does this mean for us when we're looking for a mortgage? As many of you will be very familiar with now, mortgage or base rate coming down doesn't necessarily feed straight through to mortgage pricing. Indeed, the only people who really benefited from the earlier increase in base rate reductions this year was those borrowers who have base rate trackers where there is no floor built into their mortgage contracts. They benefited directly from their mortgage rate coming down. But actually, in terms of the feeding through of base rate reduction to mortgage borrowing for new borrowing, it simply doesn't happen proportionately, if at all. And that's largely due to the way that these mortgage lenders, buy-to-let mortgage lenders, arrange their funding. So yeah, I don't know that we're going to have a reduction in base rate, and I certainly don't think that even if we did, it would necessarily impact those borrowers. So for people who are thinking they're going to hold off making either buy-to-let mortgage acquisition decisions or indeed remortgage decisions because they're expecting rates to come down further, being really honest, I'm not convinced this is going to benefit you in the long run. So there you have it, the buy-to-let mortgage market news from me this week. Thank you, as always, for joining me. I hope you found it helpful. And as always, lots of information on our website, mortgagesforbusiness.co.uk, or do give us a call, 0345 345 6788. If you call today, you might even get through to me as I'm in the office. But yeah, and I'll catch you next week. And until then, look after yourselves. And for those parents who have children back to school, enjoy the break.